All right, what's up, everybody? Welcome to the official Trade Talk channel where I show you how I analyze price for the most consistent and higher probable entries to help you guys become better traders. So, last week we put out a video called, I don't even remember what it's called. What was it called? No, it wasn't that. No, it wasn't that. What was it called? Long call options. There, boom, long call options. Today we're going to be talking about short call options. I hope you're ready. All right, so let's just go back in what we discussed last week, or maybe you didn't see last week's video. If you did not, this is going to be a series, so you need to subscribe now. That way you can follow along as I go on with the series, right? You don't want to start on video 5 because if you don't know anything about options, you're going to be completely lost. Now, the buyer of a call option pays a premium. The reason I'm leaving this on the screen is because this is the definition of calls and puts as I know them. The buyer or holder of a call option on a stock. Let's call the stock. What stock? What stock? Let's call the stock TT. Why are we calling the stock TT? Well, of course it is obvious, right? So we are trading the stock called Trade Talk, or TT for short, right? That's the stock we're trading. So if we go out there and we buy a call option, that means we have to pay a premium for the right, but not the obligation to buy Trade Talk at the strike selected prior to expiration. All right. So in last week's video, we discussed strikes, what they are, right? It's price. We discussed expiration in the options chain of whatever product you want to trade, whether it be indices or individual stocks or futures, or they have options on futures now. It's amazing. You can go out there and you can trade options on it. So expiration in the option chain on the strike that you select. If you look at the expiration first, it'll tell you how many days is left on this option premium before it expires worthless. If it expires in the money, it will have intrinsic value. If it expires out of the money, it will expire worthless. In the money has intrinsic value. Why does it have intrinsic value? Because the stock is trading at that price or above. So if you buy a $100 call, if you buy the 100 strike, right? Strike. In the stock TT, and TT stock goes up to 110, this would be 100. Of course it would. Why wouldn't it? I mean, Trade Talk stock, come on. Of course it's going up, baby. It's going to the moon. Well, anyways, if you bought it at 100, right, and then it was trading at 110, that's supposed to be a 110, then that means your option premium would have what? $10 of intrinsic value. Intrinsic value. Because your premium is in the money. So in the money, intrinsic value. Out of the money, worthless at expiration. On to writing calls, also known as selling calls. If you are a seller of a call option, you are a writer of a call option. And when you write a call option, you collect a premium, right? You collect a premium. Remember, when you're a buyer, you pay a premium. This is the opposite. You collect the premium. Now, when you are long options, the premium that you pay obviously will expire worthless. So that's your risk. So if you pay $350 for the strike and your strike isn't in the money by expiration, then your $350 goes down to zero. That is what you are risking on a long option. You are risking the premium. Now, you don't, say you can't go out and buy or sell a call option and get $1.44, for instance, for it, and then just immediately go out and rebuy that option back and keep the $1.44. It doesn't work like that. You get the money up front, sort of, right? It just matters how long you're in the stock, where the stock price is, and all that other stuff will determine how much premium you keep. But anyways, the difference between a buyer of a stock or a buyer of an option and a seller of an option is the buyer of the option buys the premium, the seller of the option collects the premium. All right. I think I've beaten that into your head enough. Now it's time to get real. How much risk is associated if you are a call seller? Because remember, if called upon prior to expiration, you are obligated to sell stock at the strike price. So how much risk is associated with selling premium? Here, let's do this. That's right. If you sell premium naked, YouTube, he said naked. Things are about to get dirty around here. Just kidding. What naked means is anytime you sell an option of a underlying asset that you do not own. You have infinite amount of risk. All right. So basically, if you sell Trade Talk stock for $100, right? And you're at that strike and you sold it for a premium and you got, let's just say a buck 40 for it, right? Then that's the amount you can make. That's it. You can only make the 140 and only if the stock is trading under $100 at expiration. Then you will get the 140, right? Now, say the stock jumps up to 110 and you sold short the 100 call. Well, guess what? You're going to get called away. That means you got to go out there and you got to buy 100 shares of said stock at the strike price selected, which was 100. So 100 times 100 is 100 hundreds, right? So that's a lot of money. That's why a lot of people can't sell options on some platforms because they have small accounts. If you have under $5,000, it's going to be impossible for you to sell options naked on Thinkorswim unless you have a ton of margin. Margin simply equals money or funds in the account. All right? You need to have like a lot of money in the account to cover the actual trade. And if you don't have it, they won't let it go through. Not all brokers, but most. For instance, the broker we're going to talk about tonight, and I'm going to show you some examples about selling premium, does let you sell it. And it doesn't have to be a micro, which is that MES right over here. That's the micro ES futures. I actually went out today and sold a naked option, a call option, and here it is. All right, here is Meta, also known as, or formerly known as Facebook. And you can see right here that I sold a call for what? $1.44 premium. I sold exactly one lot. So that means 100 shares. So this $1.44 will equal at expiration, as long as Meta stays below 350, I will collect $1.44, which is $144. Considering the account is only $5,000, that is a nice return on capital. It's better than 1%. Hell, it's better than 2%. It's damn near 3%. But we don't intend to hold this to expiration. Why not? Well, if you look right here, you can see that I sold the July 28th, 2023 call, the 350 strike. There is only 4 days to expiration. The reason I sold it is because of this. Look at that IV, that beautiful implied volatility. Look at it. It is gorgeous. 110%. The market is now closed, but it is up there, right? And it's only 4 days away. So at 4 days, option premium starts to decline rather quickly. And I can prove that to you. If you look right here, there's a category called theta. This is theta. All of this right here. That's your theta. What is theta? Theta is time. value. Theta is time. It is a Greek word for time decay. Remember, in the options video I put out last week, I told you that implied volatility and theta are priced into these strikes, right? Each one of these strikes are priced by implied volatility, theta, and some other things, supply, demand, other things, right? But mainly the reason I sold this call was because the IV was up so much. What is the IV immediately going to do to the premium? It's going to jack it up, right? It's going to make it very expensive. So for anybody that was going out there and buying calls today, hopefully you bought close to the money because you got earnings on Wednesday post market. And my whole goal here was to collect time decay of roughly 40 cents, depending on which way the stock goes, up or down. I am looking to collect about 40 cents a day. So Wednesday at roughly, let's just say 2 o'clock p.m., that's when I'm going to let go of this position. And hopefully, when I let go of this position, the ask will look something like that. Yeah, it can be that easy. But remember, I have unlimited risk. Unlimited risk. So I am literally risking infinity for a meager $1.44. That's not a very good risk to reward, is it? No, it's not. Not even a little bit. However, as we go on in these options videos, I'm going to teach you strategies like this and many, many more that will help you. Now, let me go over here to what is called POP, P-O-P. P-O-P simply means probability of profit. All right? Now, it doesn't mean the probability of making $144 on the trade. It simply means probability of profit of making 1 cent or more, 1 penny or more, all right? 1 penny or more. So I have 95% probability on this trade of making 1 penny or more. All right. So those probabilities go both ways, don't it? So if I go over here and just change this to probabilities of in the money, I can look over here. The market is closed, but earlier today, which since there is a 95% chance of making 1 penny or more, you would think that this would be a 5% chance of the 350 strike trading in the money in what? 4 days, right? There is a 4% chance that Meta will be trading at $350 in 4 days. That's a pretty good chance. No, it's not. It's a terrible chance, right? It's absolutely ungodly terrible. So, it cannot happen. Yeah, there's a 4% chance it can happen. 4% chance that it can happen. You're never going to find a 100% probable trade. You can get them close. You can get them into like 97%, but you can't get a 100% because the market, nobody knows what the market is going to do, right? Nobody knows, not even the options market. So far, the options market with the implied volatility and the amount of time left and everything else, all the other Greeks, the market is saying that theta is going to move up or down $25.80 in 4 days. $25.80 in 4 days. Let's go back over here to Meta. Meta. All right. So we want to do what? 25.80. So let's just round it off and call it $26. All right. So we're trading at, let's round it off and call it $2.92. So it can go up $26. So 302, that's 10. So 322 would be 20. So let's just say 327. All right. There is a This is where the options market is pricing the fact that Meta could potentially go. Now up here, you can see is my strike. It is well out of the money, right? It's another $25 or $22 away from the options market price than expected move high. Now, since I am short calls, that's not necessarily a bearish position. It's not a directional position. It just simply means that I want Meta to stay under 350, right? Because I am short a call. So yeah, that's that. All right. So, and it can also move, like they said, right? It can also move $25 to the downside. So what? 72 plus 5, let's just call it 66. So this is the range that they think Meta will do, right? That is the implied volatility expected move in 4 days. Why so big? Because they have earnings on Wednesday. That's why. So we're not going to hold this call, this short call, into earnings. No freaking way. Because just my luck, this thing will shoot way up above 350. All right? Way up above. And then open at like 370 and I'll immediately get margined out. No, we're not going to do that. What I'm going to do is I'm going to collect what? Theta. That's it. That's all I'm doing here. I'm just collecting time value. And since we're so close to expiration with this high of an implied volatility, it's a given, right? Like I had to take that trade. It has a 95% probability of making 1 penny or more. And let's be honest, if we can make 1 cent, then we made a penny profit. And that's what we're trying to do here, right? Make profit. So yeah, what I wanted to also say is when I partaked in this trade, when I partook in this trade this morning, I sold the option premium. There was less than 100 volume. Less than 100 volume there this morning. Less than 100. Look at that. There is 1,990 people that did the exact same thing that I did, that saw the exact same thing that I did, which was what? The implied volatility and the measured move and the earnings and all of that, and how jacked up this premium was so far out of the money. So there's what? There's almost 2,000 people. Well, let's say 1,800 people went and did the same trade that I did after I did it. That's also a pretty damn good sign, right? I don't need my POP or POP or probability of profitability to tell me that that's a damn good trade. I could have just simply watched the volume pile in. Also, if we come over here to Facebook, Meta, and we look at calls that were traded at the bid or below is 97,000. That is call selling. Remember, you are a seller on the bid. You are a buyer on the ask. When we look at how many calls were bought today, it was 86,000. So a lot more call selling going on today. But there was also more put selling going on than put buying today. Yeah, people are hedging. Right? They're hedging their gains. Meta is up huge on the year already. They're just hedging. But I went out there and I sold naked. And that's what I do not want you to ever do, right? Because it has infinite risk associated with it. And if you do not know how to trade, if you don't know what strike to look for, what implied volatility, what delta to look for, what's the theta on that delta, if you don't know that kind of stuff, then you definitely don't want to be selling calls naked. What is a naked call? Once again, it means that you don't own any of Meta stock. Now, if you owned over 100 shares of Meta, then you could go out and sell a call against the shares you own, and that would be called a covered call strategy, right? Covered calls. It's when you go out and sell premium against the shares you own. It's just a way to collect income as prices bouncing around. Well, I don't own Meta. I own a few other stocks that, are just in a sit and wait, hold portfolio. But if you think that I'm not going out there and selling premium on some of that stuff, no. That's what a trader does is a trader looks for any and every single edge in the marketplace. Since not one person in the world knows what price is going to do, they have a 50-50 shot of getting it right. And on this specific trade, I had a 95% of probability. Do you think that I have any edge? I have no idea what this stock is going to do. It could go up, it could go down. I don't know. But do you think I have an edge? Anything over 50% is an edge. And if you have a better than a 2-to-1 hit rate, you're gonna kill it in trading options, right? You're gonna kill it. And we're gonna kill it together. I'm gonna do my best to help you. So what have we learned? We have learned the seller of a call option collects the premium and is obligated, if called upon prior to expiration, to sell a stock at the strike price selected. There is only a 4% probability that this stock is going to 350 in 4 days. That, my friends, is edge, right? That's edge. And 2,000 other people noticed the same thing that I noticed. And if you look down a little bit lower, down at that 360 strike, that boy got 2,500 people all over it. Let me explain something to you. 75 cents. You can do more contracts than one, right? If you got a big account, like if you're sitting on 100K, you could do 10 contracts. And that wouldn't be around $100 you would be making on this trade. That would be $1,000. And it only is going to take 2 days. So do you think you can day trade options? Yes, you can. I'm going to teach you every single strategy that I know. I'm going to teach you strangles, straddles. I'm going to show you butterflies and broken wing butterflies and iron condors and you name it. If there's a strategy on Thinkorswim, an option strategy, verticals, I'm going to teach you back ratio spreads. I'm going to teach you everything that I know about options. And that way you'll have a much better chance of making money in the options market. And I'll promise you this, once you really understand options, you probably won't want to trade anything else. And that's just honesty. I like to trade Forex because I can mitigate my risk very easily trading Forex, right? I risk 1% to make 2% every trade I take. I don't ever raise it. So I do still trade Forex when I find a setup. I've been busy these days, so it's not like I can look every single day, but we are going to get you guys situated, or I am going to get you guys situated. Hopefully you enjoyed this video. Sorry about a bunch of the rambling and stuff, but I'm just trying to make it entertaining as well as helpful and learnable. You guys have a fantastic rest of your day. Make sure you guys trade safe, trade smart, and as always, happy trading, everybody.